Okay. All right, do that. We need to get a, So, in chapter 5, now, why don't we do this? Why don't we have a quick review of where we are up until now? And then let's go on, okay? So if we do problem, and why don't I do it? Or quick study 5 dash, or no, exercise 5-2, page 211. Why don't I do it? And what it'll do is it'll summarize all of the, let me turn up the light here, so you can read on the board. And let me go ahead and turn this camera around. There you are. So here's what it is. And what we're going to do is we're going to summarize the buying and selling. We're just going to review it. And let's set this here. And let's check. Let me do this. Chapter 6.
Isn't it horrible how one little thing can just throw you?
Yeah, it is. And, oh, here they are. And what it is with that online class, if a problem comes up, the best thing to do is drop everything and solve it. Because if you don't, you just inconvenience so many people.
And everybody's emailing you going, this isn't right, this isn't
Exactly,
right.
yeah.
It's like,
So, yeah, and then of course, so anyway, often it's just time to try another browser, but none of them work. Anyway, but you gotta take care of that right away. And so, anyway, but it does work that way. Let's go ahead and do this. Now, here is the problem. So it's exercise 5-2, page 211. So what it'll do now, let me put it up here on the board, is what it asks you to do is so it has a buyer and it has a seller. Okay, so it's right here. I'm going to go ahead and make it bigger. All right, so it has a buyer and a seller, and it asks you to record the transaction as the buyer and as the seller. So, and then both of these are using the perpetual inventory system. So, let me go ahead and put this up here. Go ahead and review it for you. So basically what it says is the Taos Company purchased merchandise for resale from the Tucson Company with an invoice price of $22,000, credit terms of 310, net 60. So 3% discount to pay in 10 days. The whole thing's due in 60. The merchandise had cost Tucson $15,000. Taos paid within the discount period, assumed that both the buyer and the seller used the perpetual inventory system. So prepare these entries that the buyer should record for the purchase and the cash payment. So in this case, it's the buyer. So let's start with the buyer. So in this case, the buyer is the Taos Company. These are credit purchases. Okay. So let's start with the buyer. By the way, I have more of a fine tip pen here. Let me use that instead. We have the buyer, which is the Taos Company. And it's a credit purchase. And what it is we're going to debit merchandise inventory. For the $22,000, that's what they paid. And we're going to credit accounts payable for the $22,000. Okay? Then, and now by the way, don't forget, because it's the perpetual system, we're going to put this, what we do is we just enter a purchase, we buy the asset and record it as an asset, and it's the asset's inventory. Then we're gonna do a cash payment. And in this case, so we have 22,000, they pay within the discount period. That means they get a discount of $660. So this is the discount. Now don't forget, under the perpetual system, what we're going to do is we're going to credit the inventory account because every asset is listed at cost. When we pay 3% less, 0.03, then we have the cost is 660 less, so the value of the asset is 660 less. So in this case, the accounts payable, we're going to pay out for 22,000. And this accounts payable is that accounts payable. Okay? Merchandise inventory. And I'm just going to write INV for inventory to move along. It'll be credited for 660. So the discount lessens the value of the asset. That's why we're going to credit the asset. And then the difference of 21,340 is a credit to cash because that's how much we pay. Okay? Does that sound good? All right. Now, let's take a look at the seller's books. And of course, the seller is the Tucson Company. All right. And now it's a credit sale. And so being a credit sale, what we're going to do here is accounts receivable. So in this case, we're going to have two entries. The first entry will update the revenue account. So accounts receivable is debited for 22,000, and sales is credited for 22,000. Okay. Then we're going to update the expense account. So cost of goods sold is the expense. And we're going to debit it for the 15,000, and we're going to credit merchandise inventory for the 15,000. So what happens here is this asset is now converted into an expense. So on a credit sale, and by the way, don't forget, let me be sure to point out, this is the perpetual system. Okay, so on a credit sale, we update the revenue, and then we update the expenses. And the advantage to the perpetual system is all these accounts are updated on every sale, so everything's current. Then, when we get paid, it looks like this. So now, we have a cash collection. And, so in this case, again, there'll be a 660 discount. But now it's a sales discount. So what we're going to do is the cash we receive will be 21,340. And that's this 21,340. Okay? The discount of 660 now is a sales discount. And a sales discount is debited for 660. Now, the reason it's debited is because a sales discount is a contra revenue account. And a contra revenue, of course, is credit, so a contra revenue will have a debit. And every contra account is called a valuation account, and it determines the true value of the sale. So the sale really isn't to 22,000, because if you don't receive the money, it's not a sale. So the sale will end up being the same as cash in this case, because you're going to take away the amount you don't collect. And this is a contra revenue account. Okay? And then, of course, you're going to debit accounts receivable for the full 22,000. Okay? Let me put up a printed copy in case anyone has a question. And the purpose of this was just to review so it's fresh in our mind before we proceed on.
Thank you.
So the roll is coming on, yeah.
So I guess the thing I don't understand, and I was trying to figure this out yesterday, is why on the cash payment, like, when you get the, discount, why you would credit merchandise inventory, because it's not, you just got a discount, like, the merchandise wasn't damaged, it's not worth less, is it?
What a good point. You don't forget, you're right, it's not, from the stand, you know, from the retail value, it really hasn't lost any value. From a cost perspective, you paid $660 less for it. Basically, let me just kind of put this in more of a bigger perspective, because I see that didn't quite work as far as an answer goes. What happened on this thing is, after the Great Depression, they took a look and says, what are the causes? One of the causes was faulty bookkeeping. And so what they would do is they would buy something, search around, find where they could have paid more for it, took the difference, put it on the income statement as revenue. Well, it's not, right? So finally they said, the fairest thing we can do is to value every asset at cost. What you pay for it is what it's worth. You have two parties, they bargain at arm's length, they come to a price where one is willing to sell, one is willing to buy. That's what something's worth. So we're going to value everything at cost, right? Now, when that happened, the cost of the inventory just decreased. So when we value everything at cost, we lowered that cost by $660 because we got a discount. And that's the fairest representation of what something's worth. And you're right, that it wasn't damaged, you're right, we didn't return it, all that's true. But we value everything at cost. If the cost goes down, the value goes down. And that's just the fairest representation that we can have for something. All right, and that was a good question, Max. Any other comments? You guys doing good? All right, let's do this. Let's go on with chapter 5. After that review.
So we're skipping 3.
Yeah, let's just skip 3 because I think we can make the best use of our, just because we can make the best use of our time. Now, you want the answer to it? Here's the answer to 3. And, all right, now, yeah, and the reason I put that up there is I just wanted to have a review, so, okay. All right, you guys doing good? Now, let's get into closing. Now, don't forget, there's 4 steps to every closing process, right? So this is closing. So steps 1 and 2 can be reversed. Step 1 is you close revenue to income summary. Step 2, are you close expense to income summary. Step 3 is you close income summary to capital. And then step 4 is you close withdrawals to capital, right? So these are the 4 steps we've been working with. Now, when we have a merchandising business, we're going through the same 4 steps, except we're going to add a few things, okay? So let me put up an example of closing using the in the perpetual method. Are you guys done with this? All right. So here's what the closing entries look like. Okay. Under the perpetual system. So in this case, Here's what they look like. It's the same 4 steps. So it's the closing entries for a merchandising business. So step 1 over here is close revenue to income summary. The only thing that's different about it now is the name for the revenue account in a merchandising business is sales. Okay? So, and this is kind of a unique name for that. Then we're going to close expenses to income summary. Now the only thing that's different here is we have an additional expense account, cost of goods sold, and these 2 contra revenue accounts, they're temporary accounts, they're closed with the expenses. Okay? They have a debit balance, and they're just closed with the expenses. Okay? Then step 3 is we're going to close the income summary to capital. So just as before, we find the balance of the income summary account, the credits exceed the debits, so that'll be what? A net income, right? And when it's a net income, we credit capital to increase it. Had the debit's been larger, we would have decreased the capital because there would be a net loss with the debit. Okay? And then step 4, just as before, is we close withdrawals to capital. So same 4 steps, except now we have a name that sales, which is what a income, which is the revenue account for a store. We have an additional expense account, and we close the contra revenue accounts, they are temporary accounts, with the expenses. Okay, so those are the changes. Now, just as before, okay, now you guys are doing good on that? All right, now, do you remember when we, oh here, let me show you. Now, what happened here is, here's an example of the income statement we've been working with. It's called a single step income statement. So what it does, this is the single step income statement, it's the kind we've been working with. What it does is it puts all of your revenues together, finds the total revenues. In this case, there was the net sales. They had money coming in from a loan. When they sold the building, they sold it more than they paid for it. Okay? Expenses, here's your cost of goods sold, your selling expenses, general administrative expenses, interest expense, total expenses. Revenue minus expenses equals net income. Right? That's the one we've been working with. Now, do you remember when we had the balance sheet? And we built the classified balance sheet, and that divided things into categories, and those categories really made it a lot easier to make sense out of that balance sheet, right? Well, the same sort of thing happens with the income statement. So we're going to have the exact same accounts, but now we're going to break them into categories. And these categories will, this is called a multi-step income statement. And these categories help you to understand how the business is doing much better than the single step. All right. Now, you'll end up with the same net income. All that's different is the format, and the format will enable you to understand how the business is doing. So, let me put this up here. So, in this case, let me make this a little bit more readable. And notice the net income is the same, 14,900 in both, 14,900. The same, the net income is the same in both cases. Now what happens here, the first thing you do is you figure gross profit. And gross profit equals sales, and then if your customers bring it back, it's technically not a sale, so you take out sales returns. If your customers take a discount, if you don't receive the money, it's not a sale. So those two added together is 6,300. So net sales is 314,700. And so net sales is really what your sales are, right? Because if you don't get to receive the cash and your customers bring it back, it's really not a sale. Then you subtract your cost of goods sold, and that gives you your gross profit. Okay? Now the reason this is really important is because if you're a store, marking up your goods is how you make your money. Okay? And if you mark it up to, so, for instance, Walmart and all the other mass merchandisers mark it up a little bit, sell a whole bunch, make a lot of money. Someone like Nordstrom marks it up, so a store like Nordstrom has to mark it up a lot because their customer service generates a lot of overhead, right? So you gotta keep an eye on this. If Walmart starts charging more than a little bit for each of the items, they simply change their business model. And there's nothing wrong with that, but they say, do I want to change my business model? Is there some advantage to become something other than the mass merchandiser we've been? If Nordstrom starts to lessen their margin, then again, they change their business model. Nothing wrong with that, but do they want to change their business model? So, you start out finding the gross profit. Now you take away your operating expenses. So down here you have $71,400 of operating expenses. And notice that there's two categories of operating expenses. So here's your operating expenses. You have selling expenses and you have general and administrative. Breaking them out like this really helps, and I'll show you why in a minute. So selling expenses are all those expenses that are related to making sales. Okay, so what we're talking about here is here's the depreciation expense for the store. Here's the sales salary expense. Here's the rent expense for the selling space, store supplies, advertising. All of these expenses are directly related to sales. Then we have the general administrative expenses, and another name for this is overhead. And they consist of things like, here's the depreciation expense for the office equipment, office salaries, insurance expense, rent expense for the office space. The security guard would be in here, personnel would be in here, or, human resources. Accounting would be in here. And so these are overhead. Now this is necessary. Now the reason it helps you to separate them out is because these are directly related to generating revenue. These cause revenue. Okay, so the question is, are these causing the revenue that you want? Is the cause, is it doing a good job of generating it? The problem with these is you have to make sure that they stay in line. And it's so easy to, everything creeps up, you get used to paying more, and sometimes these can get out of line as to what they should be. So you need to maximize the benefit of these. These are kind of like a fixed cost. These are kind of like a variable cost. But they're two different categories of costs that operate differently, that have different purposes. These are necessary, but you got to just get the most out of them. And these, you got to make sure they're producing sales, they're producing revenue. Then you have income from operations. Now, if you were going to buy the store, this is what you'd buy, okay? However, this store had, in this particular year, had additional sources of different additional revenues and expenses. So what they had is, in addition to income from operations, and I'll leave this up here, they had, so in addition to that, they had interest revenue. Now in this case, they're not in the business of lending money, but somehow they lent somebody some money, who knows why, and they made $1,000 in interest, okay? They sold a building, and they sold it for more than the book value. That's a gain, right? But they don't do, they're not a real estate agent, they're not in the business of buying, selling buildings. It's a one-time deal. Who knows, they may have owned it for 30 years. Of course, they should have had more appreciation after 30 years, but. And then the same thing with interest expense. So it turns out they had additional, a net of $2,000 of additional revenue and expenses for the total income. Now, just to make this a little bit more easy to remember, when Hurricane Katrina hit, the stores down in New Orleans reported their losses down here as other, right? Because it had never happened to them before. And that made sense. FASB says, not so fast. Now, you guys built a store in Hurricane Alley. You got hit by a hurricane. What do you expect? Okay, so the name for that specific one is an extraordinary gain or loss, and one definition of an extraordinary gain or loss is that it's not related to the business per se, and hurricanes are, and it's unlikely to happen in the foreseeable future. Well, that's not true. It's very likely to happen in the foreseeable future, okay? So, the reason I'm saying that is these are things that are kind of peculiar to a specific year. They have nothing to do with operations, so they're reported down here. It turns out that FASB says you gotta report it up here simply because it's the cost of doing business in Hurricane Alley, okay? And again, the purpose of this is what's, from here up, is what's likely to repeat. If you're going to buy the business, this is what you buy. These are revenue and expenses, gains and losses. They need to be reported as on the income statement, but they're separated out just because they're kind of like a one-time deal. They're not related to the general line of business, okay? And so with the multi-step income statement, it breaks it down into categories that enable you to make better decisions. Now, about half the companies in the U.S. use the single step and half use the multi-step, which is kind of surprising because this gives you so much better information. The people who advocate for the single step say, it's easy to understand. We publish this, the readers know what we're talking about, right? And that's the best thing we can do is just present understandable information. That's why they use the single step. Okay. All right. Now, let's do this. I'm going to take a look at this. Then the other thing that I'd like to mention while we're on the topic is when we do the classified balance sheet, generally merchandise inventory appears something along in here. So don't forget, the assets are listed in order of liquidity, okay, the current assets are. And what this says is you expect to collect your accounts receivable, normally they're doing 30 days, before you sell your inventory. You expect to sell your inventory before you use up your office supplies. And of course, prepaid insurance, that's generally by the year, okay? So that will generally last a whole year. So this is where they'll show up on the classified balance sheet. All right. Now, let's do this. Let me take a minute here. I'm going to pause this. And let me,